In 1996, Ray Dalio ran the numbers on a typical diversified portfolio and discovered something terrifying. It wasn't diversified at all. 95% of the risk was coming from a single bet. Here's what he built instead. Spring 1996. Bridgewater Associates headquarters in Westport, Connecticut. Ray Dalio is sitting in a conference room with his research team, and they're staring at a problem that's been bothering him for months. Bridgewater manages billions for institutional clients, pension funds, sovereign wealth funds, central banks. These are sophisticated investors. They all think they're diversified. 60% stocks, 40% bonds, the classic balanced portfolio. It's what every financial advisor in America recommends. But Ray's been running simulations and the numbers don't lie. He pulls up a chart on the screen. Look at this, he says. A 60-40 portfolio. Everyone thinks it's balanced because 60 and 40 are different numbers, but watch what happens when we measure risk instead of dollars. He clicks through to the next slide, the risk contribution chart, and it's not even close. 95% of the portfolio's risk is coming from stocks, 5% from bonds. Someone in the room lets out a low whistle, so when stocks crash, the whole portfolio crashes, Ray finishes. You're not diversified, you're making one bet. You're betting that growth accelerates and stocks go up. That's it. That's the only scenario this portfolio works in. He stands up, walks to the whiteboard, draws 4 boxes in a grid. There are 4 possible economic environments we can be in, he says, marker squeaking on the board. Rising growth with rising inflation, rising growth with falling inflation, falling growth with rising inflation, falling growth with falling inflation. He taps the top left box. Traditional portfolios only work here, in this one box. The moment the economy moves to any other quadrant, you're exposed, catastrophically exposed. The room is silent. Everyone's thinking the same thing. If this is true, and the math says it is, then every pension fund in America is walking around with a ticking time bomb. Ray caps the marker, turns back to the team. We're going to build something different, a portfolio that works in all 4 boxes, no matter what happens to growth, no matter what happens to inflation, equal risk, real diversification. One of the analysts speaks up. That's never been done before. Ray smiles. I know. That conversation led to the creation of the all-weather portfolio. And over the next 28 years, it's going to prove him right in ways nobody expected. I'm here to tell you about one of the most elegant solutions to portfolio management ever created. And what's crazy is that most people have heard of it, the all-weather portfolio, but almost nobody understands why it actually works. They know the allocation percentages, but they don't understand the mathematical logic that makes it bulletproof. So today, we're going deep. I spent the last week reading Bridgewater's original client letters from 1996 when this strategy was first formalized. I pulled Ray's congressional testimony from 2009 where he explained the framework. I analyzed the performance data across multiple market cycles, and I'm going to walk you through exactly how this works, step by step, in a way that'll completely change how you think about risk. Let me start with the problem Ray was trying to solve. And honestly, this is still the problem most investors face today without even realizing it. Picture a standard diversified portfolio. Let's say you've got $100,000. Your financial advisor, or maybe you read this in a book somewhere, tells you to split it 60-40. 60,000 in stocks, 40,000 in bonds. That's diversification, right? You're in 2 different asset classes. You're spreading risk. Except you're not. Here's what Ray figured out, and this is the key insight that unlocks everything. When you put 60,000 in stocks and 40,000 in bonds, you think you're splitting your exposure 60-40. But that's measuring dollars, not risk. And dollars don't tell you anything about what happens when markets move. Stocks are roughly 3 times more volatile than bonds. Think about what that means. If the market drops 10%, your 60,000 in stocks loses $6,000. Your 40,000 in bonds, maybe it loses a few $100, maybe it gains a little depending on what's happening with interest rates. But the point is, almost all of your risk, the actual possibility of losing money, is sitting in that stock allocation. Ray did the math. In a 60-40 portfolio, 95% of the risk comes from stocks. 95%. Your bonds are basically doing nothing from a risk perspective. They're just sitting there, collecting a tiny yield, contributing almost zero to the overall risk profile. So when stocks crash, your diversified portfolio crashes. 2008, the S&P dropped 37%. That 60-40 portfolio, down about 25 to 30% depending on your bond duration. That's not diversification. That's just owning stocks with a small bond buffer. Now most people hear this and they think, okay, so I should own more bonds, 50-50, or 40 stocks, 60 bonds, flip it around. But that's not the answer either, because now you're giving up all your growth potential. Bonds don't compound wealth the way stocks do over long periods. You're solving the volatility problem by sacrificing returns. That's not a solution, that's just a different kind of failure. Ray's sitting with this problem in the mid-90s and he's thinking about it differently. He's asking a more fundamental question: why do assets go up or down in the first place? And he realizes there are only 4 economic forces that matter: growth and inflation. That's it. Is the economy growing or contracting? Are prices rising or falling? Those 2 variables create 4 possible environments. Let me walk you through them, because this is the foundation of everything. First environment: growth is rising and inflation is rising. This is the boom economy. Late 1990s, mid-2000s, everything's hot. Companies are making money hearing people expanding. And because demand is strong, prices are going up. This is when stocks absolutely rip. Equities love this environment. Commodities do well too because inflation is rising. Second environment: growth is rising but inflation is falling. This is the Goldilocks scenario. The 1990s had stretches of this. The 2010s after the financial crisis. Growth is still positive, the economy's expanding, but inflation is contained. Central banks are happy. This is the dream scenario for financial assets. Stocks do great, bonds do great, everything works. Third environment: growth is falling but inflation is rising. This is stagflation, the nightmare, the 1970s. The economy's contracting, unemployment's going up, but prices are still rising because of supply shocks or currency issues. This is when traditional portfolios get absolutely destroyed. Stocks fall because earnings are declining. Bonds fall because inflation is eroding their value. You're getting crushed from both sides. Fourth environment: growth is falling and inflation is falling. This is deflation, the Great Depression, Japan in the 1990s. The 2008 financial crisis almost became this. The economy's contracting and prices are falling. Debt becomes crushing. Nominal assets lose value. This is when long-term bonds absolutely soar because interest rates collapse and the fixed payments become more valuable, but stocks get hammered. 4 boxes, 4 totally different realities for your portfolio. Now here's the thing Ray realized that changed everything. Most portfolios are only optimized for one of these boxes. That 60-40 portfolio we talked about, it only works in environments 1 and 2, rising growth. When growth is rising, stocks go up and you make money. When growth is falling, boxes 3 and 4, you're in trouble. You're not diversified across economic environments. You're concentrated in growth. You're making one giant bet that growth continues. And sure, over long periods, economies tend to grow more than they contract. That's why stocks have positive expected returns. But what happens during the years when you're in the wrong box? What happens in 2008? What happens in the 1970s? You lose decades of gains in a single year, and most people never recover psychologically. They sell at the bottom, they abandon their strategy, they go to cash and miss the recovery. Ray wanted to build something that didn't depend on being in the right box. He wanted equal risk in all four environments. So no matter which quadrant the economy moved into, only about 25% of his portfolio would be exposed to negative outcomes. That's the all-weather concept, not weather as in sunny or rainy, weather as in economic weather, all economic conditions. So how do you actually build this? Let me walk you through the logic. You need 4 types of assets, each one designed to perform in a different environment. First, you need growth assets for when the economy's expanding. That's stocks, equities. They do well when corporate earnings are rising, when companies are growing, when economic activity is accelerating. Second, you need inflation hedges for when prices are rising. That's commodities, gold, inflation-linked bonds. These assets preserve purchasing power when currency is being debased and prices are going up. Third, you need deflation protection for when growth is collapsing and prices are falling. That's long-term government bonds. When the economy craters and the Fed cuts rates to zero, those bonds with locked-in higher yields become incredibly valuable. Think about it. If you bought a 30-year Treasury bond in 2007 yielding 5% and then rates went to zero in 2009, that bond's price skyrocketed. Fourth, you need stability assets that generate steady returns across multiple environments. That's intermediate-term bonds. They're not as volatile as long bonds, not as growth-dependent as stocks, just steady, predictable cash flow. 4 asset categories, 4 economic environments. You're building a portfolio that has something working no matter where the economy goes. But here's where it gets technical, and this is the part most people miss. It's not enough to just own these 4 things. You have to weight them by risk contribution, not by dollar amount. Remember, stocks are 3 times more volatile than bonds. So if you put equal dollars in each category, stocks are still going to dominate your risk. You haven't solved the problem. Ray's solution: risk parity. You weight each asset class so that it contributes roughly equal risk to the portfolio. That means you're going to own way more bonds than stocks by dollar amount because bonds are less volatile. You need more dollars in bonds to generate the same amount of risk as a smaller stock position. Let me show you what this looks like in practice. The all-weather portfolio that Ray designed has 5 positions, and the percentages are going to seem weird until you understand the logic. 30% in stocks, that's your growth engine. But notice it's only 30%, not the 60% you'd see in a traditional portfolio. Why? Because stocks are volatile. 30% stocks by dollars equals about 25% of total portfolio risk. 40% in long-term treasury bonds. This is the big one. People see this number and think Ray's crazy. 40% bonds, but remember, long bonds are your deflation protection. When the economy collapses, these bonds go up a lot. They're negatively correlated with stocks in crisis scenarios. And because bonds are less volatile, you need more dollars to generate equivalent risk. That 40% bond position contributes about 25% of portfolio risk. 15% in intermediate-term treasury bonds. These are your stability anchors. 7 to 10-year bonds, less volatile than long bonds, more yield than short bonds. They smooth out the ride. Another 25% of risk. 7.5% in commodities. This is your inflation hedge. When prices are rising, commodity prices rise. oil, agriculture, industrial metals. They're real assets that maintain value when currency is being debased, about 12.5% of risk. And here's the one everyone asks about, 7.5% in gold. Now, gold is controversial. A lot of modern portfolio theory people will tell you gold is useless. It generates no cash flow, no dividends, no interest. It just sits there being shiny. But Ray looks at gold differently. Gold is the ultimate inflation and uncertainty hedge. When confidence in government and currency collapses, gold goes up. When inflation spikes unexpectedly, gold goes up. When geopolitical risk explodes, gold goes up. It's the anti-fragile asset, and historically, over long periods, gold has maintained purchasing power even when currencies have collapsed. That 7.5% gold position contributes about 12.5% of portfolio risk. Added up, you've got 4 to 5 asset categories, each contributing roughly equal risk. No single position dominates. No single economic scenario can destroy you. Now I want to pause here because this is where people's brains usually explode. You're probably thinking, wait, if only 30% is in stocks, won't my returns suck? Stocks are the growth engine. Bonds barely keep up with inflation. How does this portfolio actually make money? Great question, and this is where Ray's genius really shows up. The answer is leverage. Stay with me on this because it sounds scarier than it is. Traditional portfolios use no leverage. If you have $100,000, you invest $100,000, but that means you're stuck with the return profile of whatever you buy. If stocks return 8% a year on average, your $60,000 in stocks makes about $4,800 a year. Ray's approach uses modest leverage on the lower volatility assets to bring overall portfolio returns up to market levels while keeping risk lower. Bridgewater's institutional version of all-weather uses leverage. The version Tony Robbins popularized in his book for retail investors doesn't use leverage because most people don't have access to cheap institutional leverage. But here's the key insight. You can use a small amount of leverage on bonds and still have lower overall portfolio volatility than a stock-heavy portfolio. Bonds are so much less volatile that even leveraged 2-to-1, they're still less risky than stocks. I'm not recommending you go out and start leveraging your portfolio. That's beyond the scope of this video and requires careful implementation. But I want you to understand why institutional investors who use the levered version of all-weather achieve stock-like returns with 50% less volatility. For the retail version, the one you can actually implement in a normal brokerage account, you're looking at more conservative returns, somewhere in the 6 to 8% range historically, but with dramatically lower drawdowns during crises. Let's talk about performance because this is where theory meets reality. 2008, the financial crisis. The S&P 500 drops 37%. The traditional 60-40 portfolio drops about 25 to 30%. People are panicking. Lehman Brothers collapses. The global financial system is on the brink. Bridgewater's all-weather portfolio, slightly positive for the year, not up 30%, not a home run, but positive. While everyone else is losing a quarter to a third of their wealth, all-weather clients are basically flat. How? The stock allocation got crushed, sure. That 30% in equities probably dropped 35–40%, but the long-term bond allocation soared. When the Fed cut rates to zero and the market panicked into safety, those long bonds went up 20, 30, 40%. The bond gains offset the stock losses. That's diversification, real diversification, not correlation in normal times, but negative correlation in crisis. 2011 European debt crisis. Markets are freaking out about Greece, Italy, Spain potentially defaulting. U.S. stocks drop about 6% for the year, all weather up about 5%. Again, bonds rally as rates fall, offsetting equity weakness. But here's what's interesting. All weather also performs fine in normal bull markets. 2017, stocks rip higher, up 21%. All weather is up about 13%. You give up some upside, sure, but you're still making money, you're still compounding. The magic is in the consistency. From 1996, when Ray formalized this strategy, through 2024, the all-weather approach has had very few negative years. Single-digit losses in the worst years, instead of the 20 to 50% drawdowns you see in equity-heavy portfolios. And here's what that does over time. It allows you to compound without interruption. Let me show you the math on how 100,000 becomes 500,000 using this approach. If you can generate 7% annual returns with very low volatility and very small drawdowns, you're doubling your money about every 10 years. 100,000 becomes 200,000 in 10 years. 200,000 becomes 400,000 in another 10 years. You hit 500,000 in about 23 years. Compare that to a more aggressive portfolio that averages 10% returns but has massive drawdowns. You might hit 500,000 faster in a perfect bull market. But if you hit a 2008-style crash halfway through and lose 30%, you've just set yourself back years. Most people don't have the stomach to hold through that. They sell, they panic, they abandon the strategy. The all-weather approach isn't about maximizing returns. It's about maximizing the probability that you'll stay invested through all market conditions. It's about removing the psychological pain that causes people to make catastrophic timing decisions. Ray talks about this all the time. The biggest risk in investing isn't market risk, it's behavioral risk. It's you panicking and selling at the bottom. It's you getting greedy and over-concentrating at the top. The all-weather portfolio is designed to keep you in the game no matter what the economic weather looks like. Now, let me address the criticisms because there are legitimate debates about this approach. First criticism: bond yields are way lower now than they were in 1996 when Ray built this. In the 90s, you could get 6, 7, 8% on long-term treasuries. In 2020, yields went below 1%. How does all-weather work in a zero-rate environment? Fair question, and the answer is less effectively, but still effectively. Lower bond yields mean lower forward returns for the bond allocation. You're not going to get the same performance from 40% bonds at 1% yield that you got from 40% bonds at 6% yield. But the diversification benefit still holds. Even at 1% yields, long bonds still rally hard when growth collapses and the Fed cuts rates. They still provide negative correlation to stocks in crises. They're just not generating much income along the way. And by the way, this has already been tested. From 2010 to 2020, we lived through the lowest interest rate environment in modern history. All weather still worked. Returns were lower, sure, but the strategy still protected capital in down years and still compounded over time. Second criticism: what about inflation? If we get 1970s style inflation, bonds get destroyed. Yields rise, bond prices fall, and suddenly your 40% bond allocation is a disaster. Also a fair point, and this is why the portfolio has commodity and gold exposure. 7.5% commodities and 7.5% gold are specifically there to offset bond losses in an inflationary environment. When inflation spikes, commodities and gold typically soar. We saw this in 2021 and 2022. Inflation hit 40-year highs, bonds got crushed, but commodities and gold rallied hard. The portfolio isn't designed to maximize performance in inflationary environments. It's designed to survive them. You're not going to make 30% when inflation spikes, but you're also not going to lose 30% like a pure bond portfolio would. Third criticism, 15% in commodities and gold seems high. Those are volatile, speculative assets. Why so much? Because they're uncorrelated to financial assets. Stocks and bonds both depend on the financial system functioning properly. Commodities and gold don't. They're real assets, physical stuff, and in extreme scenarios, currency collapses, geopolitical chaos, supply shocks, they're the only things that hold value. Ray's not allocating 15% to commodities and gold because he thinks they're going to outperform. He's allocating to them because they behave differently than everything else in the portfolio. That's the whole point. You need assets that zig when others zag. And here's the thing people forget. You only need to be right once for that 15% allocation to save your portfolio. If you go through a 30-year investing career and we have one major inflationary spike or one currency crisis, that gold and commodity exposure will offset massive losses elsewhere. That's the insurance premium you're paying. Now let's talk about implementation, because knowing the theory is one thing, actually building this is another. If you want to replicate the all-weather portfolio in a standard brokerage account, you need access to low-cost index funds or ETFs for each asset class. For the 30% stock allocation, use a total U.S. stock market index fund or an S&P 500 index fund. Vanguard, Fidelity, Schwab all offer these with expense ratios below 0.03%. You want broad market exposure, not individual stocks. For the 40% long-term bond allocation, use a long-term treasury bond fund, 20-plus year treasuries, not corporate bonds, not high-yield bonds, government bonds. You want the highest quality, most liquid bonds on the planet because these are your crisis insurance. For the 15% intermediate bond allocation, use a 7 to 10-year treasury fund. Same logic, government bonds, not corporate. For the 7.5% commodity allocation, this is tricky. You can use a broad commodity index fund, but be aware that commodity ETFs have some structural issues. They're often futures-based, which means they have roll costs. Your returns won't perfectly match spot commodity prices, but it's close enough for this purpose. For the 7.5% gold allocation, you can use a gold ETF like GLD or IAU. These are backed by physical gold. Or you can use a gold mining stock fund, though that introduces equity-like volatility. Ray would prefer physical gold exposure. Rebalance annually or whenever an allocation drifts more than 5 percentage points from target. If stocks run up and your 30% allocation becomes 35%, sell 5% and redistribute to the other categories. This forces you to sell high and buy low systematically. Do not try to time this. Do not look at the economic outlook and think, oh, inflation is coming, I should overweight gold. The whole point of all weather is that you don't know what's coming. You're prepared for all scenarios. One more thing I want to emphasize, because this might be the most important tactical point. The all-weather portfolio is not a get-rich-quick strategy. It's not designed to beat the market. It's not designed to make you 30% a year. It's designed to survive and compound through all market environments so that in 20, 30, 40 years, you end up wealthier than someone who tried to time the market or chase performance. If you're young and have decades until retirement, you might want more growth exposure than 30% stocks. That's fine. The all-weather allocation is relatively conservative. Ray designed the original version for Bridgewater employees who were closer to retirement and couldn't afford major drawdowns. But the principles are universal. The four-environment framework applies no matter how aggressive your portfolio is. The risk parity concept applies. The importance of true uncorrelated diversification applies. So here's what I want you to do after watching this. Pull up your current portfolio. List out every position. Then ask yourself, which economic environment is this optimized for? If growth accelerates, what happens? If inflation spikes, what happens? If we enter a recession, what happens? If we get deflation, what happens? If your answer is I make money in 2 of those scenarios and lose money in the other 2, you're not diversified. You're concentrated. You're making a bet. And maybe you're okay with that. Maybe you have the risk tolerance and the time horizon to ride out major drawdowns, but at least know what you're doing. At least be aware of the bet you're making. Ray Dalio built the all-weather portfolio because he couldn't predict which environment was coming next. He got the 1982 depression call catastrophically wrong. Remember, that failure taught him humility. It taught him to build systems that work no matter what happens, instead of strategies that depend on being right about the future. The 4-box framework is that system: equal risk across all environments, real diversification, not diversification theater. And over nearly 3 decades, it's proven that you don't need to predict the future to build wealth. You just need to survive everything the future throws at you and keep compounding. That's how 100,000 becomes 500,000, not through genius stock picking, not through perfect market timing, through systematic exposure to uncorrelated return streams, disciplined rebalancing, and the patience to let it compound. All right, here's what I want from you. Drop a comment below and tell me what percentage of your portfolio risk is coming from stocks right now. Be honest. If you have a traditional 60-40 allocation, it's 95%. If you're 100% stocks like a lot of younger investors, it's 100%. You're making one giant bet on growth. Is that intentional, or did you not realize how concentrated you were? And if this video changed your perspective on diversification, hit that like button. Subscribe if you haven't already. We're breaking down Ray Dalio's most important strategies every week, and the next one is going to blow your mind. We're diving into the meeting where Ray fired himself as CEO of Bridgewater, handed power to 2 co-CEOs, and watched the whole thing nearly collapse. The succession planning disaster nobody talks about. I'm your host. This is legendary investor Ray Dalio, and I'll see you in the next one.